Assalamualaikum and hello everyone. Welcome to Public Finance Talk Show. So, what we are going to talk about it today? So, before that, I'm Natasalia as your host today. Today, we are going to talk about the Malaysia high government debt. What is actually government debt? So, government debt. Government debt is also known as the public interest, as a public debt, and also as the national debt to the annual government budget deficit, which is a flow of the variable debt equal to the difference between of the government receipt and also spending in a single year. Debt is a stock of variables measured at a specific point in the time, and it is the accumulation of all pirate deficit. So the government have been classified into two type of it, which is internal debt and also the external debt. Internal debt is more focusing to something that owned to within of the country, and for the external debt is something that owned for the other country and for the outside country as the lender. So we are proceed to Ahmad Ehsan as our journalist today, who in charge in this talk show.
Thank you, Leah, who is now in the main studio. Hello, everyone. I am Ahmed Hassan, your journalist. I'm now around the capital, Kuala Lumpur, to interview randomly to netizens. Hello, Miss. Sorry to bother. I am Ahmed Hassan, a journalist for the Public Finance Talk Show. So, I have a question I want to ask you. What is contrast Malaysian debt ratio with A-rated sovereigns?
Okay, so thank you so much, Mr. Isan, for the question. And to answer the question, based on the case study, Malaysia is also protected from risk arising from the currency fluctuations to its debt position. For your information, Malaysia's long-term remote money bond ceiling is unaltered at A1, and its long-term FC store ceiling is at A3. So, in addition, Malaysia's long-term foreign currency bond ceiling is unchanged at A1, and its long-term deposit ceiling is at A3. Malaysia's short-term FC bond and also the deposit ceilings are also unchanged at Prime 1 and also Prime 2 respectively. And for your information, the Standard and Poor, the S&P credit rating for Malaysia was A minus with a steady viewpoint. Where another credit rating for Malaysia was also recorded at A minus by Fitch, and Moody's credit rating for Malaysia was the final set in A3 with a steady viewpoint as well. And the Malaysia's Minister of Finance, as we all know, Tengku Zafrul Aziz, once said Malaysia fiscal deficit is set to go up. And for your information, Malaysia Parliament voted to allow the government to borrow up to 60% and 60% of its GDP as a part of their temporary steps to ease the blow of the corporate pandemic. And the voting was held somewhere around August, and the government have been positive about the economics as it was predicted to expand in the year of 2020, and where the number would grow around 5.5% to 8% from the negative growth. And however, it was also estimated in the year 2020 where the GDP will be slightly shrunk around negative 5.5% to negative 3.5%. And in my opinion, the Minister of Finance plays an important role in making a strategic plan, in making the budget. Plus, the minister can also continue to support to buy our local goods and also increase. Well, this will also automatically increase the revenues of our country indirectly, as this is because by supporting and buying our local goods will also help the firm survive. So that's all.
Thank you, Smee, for that thoughtful answer. Miss, sorry to bother you. I have a question. How will the increase of reliance over oil-related revenue give an impact to the Malaysian economy?
So, actually, Malaysia has been a net exporter among non-OPEC countries of natural gas and crude petroleum over the last 2 decades. Because of its massive oil and natural gas deposits, Malaysia is becoming important to the world's energy markets. While Malaysia is an producing and exporting country, it is not an OPEC member of a major oil producing country. If the world consumer price of oil rises dramatically, the price of petroleum products such as gasoline, petrol, and cooking gas in our country will be affected. One of the main causes of declining in the ringgit is the sharp decrease in the global crude oil price, as Malaysian economy depends heavily on crude oil prices to raise revenue. As we know, oil and natural gas sector was one of the important sector in the development and growth of the Malaysian economy. So the growth of this sector is closely related to overall gross domestic product (GDP). Around 661,000 barrels of oil are produced by Malaysia every day, which is generated from offshore fields. Higher oil price in this world have various consequences on both net oil importer and net oil exporter. The decline in crude oil prices and increased crude oil exporter will be directly affect crude oil exports. So, for the example, in 2019, the GDP grew 4.3%, which compared to 4.7% in 2018. The 4.3% figure was the lowest since the 2009 global financial crisis. This was the lowest rate in a decade due to the lower palm oil, crude oil, and natural gas demand, and a decline in export in the middle of the US-China trade war. So this have been proved by Malaysia's oil-related goods that account for about 9% of total export in 2019 and produce about 21% of government's revenue annually. Given the contribution of oil-related revenue to the total revenue of the country, a sharp drop in crude oil prices will also mean a fall in spending on growth activities at a time when domestic demand needs help. So, in the simplest word, if oil prices fall, it will result in a decrease to GDP if Malaysia is too dependent on oil revenue. This also possible that a more stable exchange rate, a further loosening of the policy rate, will add pressure on the ringgit to weaken against the US dollar. This is due to the fact that the ringgit is vulnerable to oil price movement. The effect of the oil price on GDP is around 0.02% for every 1% price change. The value of ringgit was lower due to the fall in oil prices coupled with monetary easing that raised the risk of potential inflation due to the higher import costs. This is not good thing in a slower economic growth environment. Other than that, Malaysia also produced the oil palm. So this oil palm industry remained as an important sector in the Malaysian economy, which contributing 4.5% to GDP in 2018. So Malaysia is the largest producer and exporter of palm oil. So the increasing in palm oil price will support trade balance and currency rise. This sector is also perceived to be the fourth largest contributor to Malaysia's economy, with a total national income of 52.7 billion ringgit in 2011 and was expected growth to 178 billion ringgit in 2020. So this is because the gross export volume of Malaysian palm oil industry in 2015 was 60.17 billion ringgit. So in determining exchange rate, the commodity price are considered important predictors. So the commodity prices are the prevailing modern monetary system for deciding the exchange rate. A change in commodity prices has been described as a critical external shock for small and developing economy. However, rising oil prices will cause a surplus for the oil exporter economy, and there will be a deficit for oil importer economic through unequal distribution of wealth, which it will turn affect the exchange rate.
Thank you, Miss. I agree with what you said. Uh, how about you, Miss? What is your opinion about the impact of swapping GST over the introduction of SST?
Okay, there are two impacts of sweeping GST on the introduction of SST, which is the first impact is government generate lesser money. This is because after the transition from GST to SST in Malaysia, the government will obtain fewer tax payment for the product. SST will apply to a smaller amount of goods and fewer business registrants will be collect it. If the country target is for the short term, then the elimination of GST can be implemented and will not interfere with the country's fiscal positions. But if for the medium and long term, it will cause a problem. So, Malaysia will be more dependent on oil and gas for government revenue, as our government expect lower revenues from SST than GST. Moreover, in the event of a rapid decline in global oil and gas prices, there is a possibility that our budget deficit will widen and this will put our currency at risk in the future. So, the second impact of sweeping GST on the introduction of SST is SST can cause the increasing in prices. SST has the potential to increase the price of goods based on the taxes contained in the goods or services that involve along the supply chain. SST does not have a system that can reclaim or offset the input tax. For example, the SST to be paid by the wholesaler or retailer will definitely be price increase for some products or services covered under SST. Furthermore, they will also have irresponsible parties involved in non-compliance and profiteering by raising prices during the months between the elimination of GST and introduction of SST. This is because they want to maintain their company's profit margin. But GST does not charge to traders and manufacturers because GST is a consumption-based tax. Therefore, SST can cause an increase in product prices from GST era in Malaysia for consumer.
Thank you, Miss. So, what I can conclude is the dominant petroleum-based revenue and non-petroleum revenue can affect the federal government's public spending. It can have important implications for the planning and implementation of national fiscal policy. That's all for today. Thank you for watching and see you next time.